What's up, everybody? Welcome to another edition of the Free Toaster News Pod. I'm Carlos Caro. I'm here with Nick Madrid, Free Toaster co-founder and co-host. Nick, we put out a piece this week on cash flow underwriting, which is a follow-up from something we wrote a year and a half ago. Doesn't feel like it was a year and a half ago. It's right around when we started the newsletter, so time flies. But a lot has changed there, and we want to cover some of that in today's episode. Before we go into that, I want to thank our sponsors, Fintel Connect, Spinwheel, and Bulldog Media Group. Nick, your thoughts?
Yeah, so thanks, Carlos. And before the news, one event you can't miss because A, we're running it, but B, we know it's near and dear to our audience's heart, is the Affiliate Marketing Summit for Lenders. Proudly sponsored by Experian and Engine by Jen. Early bird pricing is live right now at events.thefreetoaster.com. So if affiliate is any part of your funnel, you want to be in that room. The headline this week for the news edition was, did ChatGPT just fix the cash flow underwriting distribution problem? And Carlos, again, you wrote about this, you had an editorial that we also published at the same time. And, and a year and a half ago, it was, where's the consumer demand for cash flow underwriting? And the answer back then was pretty grim. And I hope we come back to that. And so 200 million people now come to ChatGPT every month. We wrote about that even last week. And a huge share of them are asking financial questions. The difference this year is that Plaid, as an example, is fully integrated. So those questions aren't abstract anymore. They're grounded in your actual transactional data. Perplexity just built the same capability. Credit Karma is plugging approval odds directly into ChatGPT experience. So when you think of that, tell me, give people a concrete vision, because it's just wild.
I think about this with something like a ChatGPT or a Claude. I know you and I are spending a lot of time using tools like this. I think I think we're getting early stages of mainstream adoption here, but people are going to be putting in their transaction data, asking all sorts of questions. And what's interesting is now that Plaid is part of the pro tier for ChatGPT, it can see everything that you spend your money on, or anything you really give it access to. That could be credit cards, banking, even brokerage. What's happening now is what lenders used to have to do there used to be this awkward moment where a lender would have to say, please log into your bank for us so that we can see if we can approve you. I think those days are gone, Nick, or I think they're going to be gone, because someone's going to trust either ChatGPT or Claude or potentially Credit Karma or Experian or some of the big financial platforms with that data, and they're not going to give it in the context of a product recommendation. They're going to give it in the context of help me manage my budget, help me answer a question about where I spent $5,000 on my credit card last month. The utility of this information has totally flipped, and it's going to enable smarter recommendations, more trust, more data, and 200 million monthly users on ChatGPT right now. So I think this flywheel has some real momentum.
Yeah. So here's my pivot, right? So distribution is the thing that changed and the thing that matters, and you've thought about this for a while, for at least a year and a half, if not further, but cash flow underwriting goes even further back than a year and a half. So maybe you can help us understand, where did this even come from? Help me understand the history, and then why is now the moment? What's happening?
I've seen cash flow underwriting in a fintech context from at least 2016. That's when I started seeing lenders kind of go big with it and kind of lead with it as a to raise money from VCs and to kind of build a business. But it's not a new invention. I think the idea is actually pretty old. The original version of this was a borrower would walk into a branch with a bunch of bank statements, usually in the context of a small business loan, and that's actually still pretty common in small business, is to underwrite based on cash flows. But the problem is it was slow, expensive, not scalable.
What happened? Is that just the issue? Is that it wasn't scalable, or was it always happening? Did the industry abandon it altogether, or did something else happen?
It was just the alternative was so much easier. So from like the 1970s on, lending consolidated around this idea of the credit bureau. So, and what the credit bureau is measuring is the willingness to pay. And it left the ability to pay, which cash flow measures, underbuilt for a long time. Um, credit data, it's simple, it's structured. The three bureaus providing it in a reliable fashion. Cash flow data is messy. It's real time transactions. They're reported in different ways. There's a guy named Larry Rosenberger who ran FICO from 91, and he put it perfectly. He said cash flow data is gold, and the only reason it wasn't used at the start of FICO is that it wasn't widely available. Um, Not that it wasn't valuable, you just couldn't get access to it.
Yeah, and I think one of the interesting things is, you and I were talking about it in the prep show. There's cash flow underwriting, and then we've written and talked about open banking before. And like, I think open banking is a separate thing, which we could do an entire episode on. But I don't think you can tell the cash flow underwriting story without naming open banking, because it's really just the enabling infrastructure underneath this entire category. Open banking is the plumbing, consumer permission, programmatic access to bank transaction data through aggregators like Plaid, MX, Finicity, and a few others that connect thousands of institutions. And it didn't invent underwriting cash flow. It just made it economically viable. It turned that shoebox into an API call that makes it happen in real time inside an online application. I think this is the moment. That's the moment where the category starts. No?
Yeah, no, that's right. It was right around 2016. That was the inflection point. So I think Plaid really got that going. So online lending enthusiasm meeting open banking. It's finally maturing. It's almost poetic. There's three companies that are central to this. You have Pedal, you have Nova Credit, you have um, Empower. They were all founded in 2016, the same year the data infrastructure kind of came to be. So to answer what you're saying directly, the manual version of this is decades old, but the modern software-driven version of this has been in market, call it 10 years. By 2018, lenders were successfully underwriting people who were called credit invisibles or thin files.
Yeah, and I think with us, like, I have to imagine this is going to be a topic that we discuss at our summit. It's so crucial. It's changing the game, and like, why is this the moment? And you and I were talking about. There's probably three reasons why. One is that it's proven. With regulators in the room. I think there's a company or a nonprofit called FinReg Lab, which showed in 2019 that cash flow variables predict creditworthiness without a disparate impact on the protected class group. So it's like financial inclusion is clearly a big important thing here. And I believe there are like federal agencies that did a joint statement encouraging lenders to use it. The OCC stood up, the CFPB was also saying some stuff. So it's like clearly there's the regulatory body that's behind these changes. I think even VantageScore shipped a version that incorporates cash flow data. And then two, the data flips from niche to mainstream. The original pitch was inclusion, and that's real, right? Roughly 26 million credit invisible adults in this country. Another 10 million are probably unscorable, and most of them have bank accounts. So this is largely visible to the bureaus, but fully visible through cash flow. And that's the line I think we keep coming back to is this infrastructure, this financial inclusion just got real. I don't necessarily think it's a slogan. It's an actual approved decline decision that anyone can execute or any lender can execute. But I think the deeper point here is, something that's orthogonal. It's this correlation between a credit score and Prism's cash score is only about, 0.22. They barely measuring the same thing. And yet cash score predicts the default about the same at about like 0.76 AUC. So it's not a worse score for thin files. It's just a different signal that improves prediction over the whole spectrum, from subprime to super prime. So
yeah, and I want to put some numbers to this, Nick, because your point around financial inclusion, I think, is very real. To me, it's one of the most exciting things about this category. Most subprime lenders I talk to, and we're talking FICO scores between like 560 and 660. They tend to approve about 1 in 5 customers that knock on their door. So about 20% eligibility rates. And when you add them all up and you aggregate them, maybe we're talking 40% eligibility in subprime. So 6 out of 10 people that apply are getting declined today. So 60% are excluded from lending, or at least at rates that are like sub 36%. You're always going to have lenders like the payday guys that can lend at 400% and can include a little bit more folks, but we're talking kind of mainstream lending. And what cash flow is doing is it's increasing that eligibility rate. So um, the last few years ran kind of a brutal experiment. Rates rose, the lenders built on cash flow got hit, but the pick and shovel layer, so the companies like Prism, Nova Credit, Plaid, they kept building, and they kept signing big banks, and they were doing so to enable customer management use cases, so like credit line increases, things like of that nature, and they were doing so to enable second looks. So um, even while the distribution side of this, so cash flow underwriters have had a hard time kind of finding new customers on a cash flow basis, the infrastructure layer has been developing.
Yeah, and this isn't going to be a regulatory piece. We probably need to find someone that can help us. But when we think about Section 1033 of the Dodd-Frank Act, I think this is one caveat I'd give for anyone that's bullish. Cash flow underwriting is only as good as the open banking layer beneath it, that infrastructure layer. So I don't think we can ignore 1033. I believe the quick status update as it is today is like, because everyone has dates that are kind of stale. We know the rule was finalized, back in October 24. The first deadline was supposed to hit April 1st of this year, I believe. But instead of going live, there's been a myriad of court cases and people trying to contest it. I know there's a federal court in Kentucky that stopped the CFPB from enforcing it while the Bureau reconsiders it. The CFPB itself flipped from trying to vacate the rule to probably rewriting it. There's still a lot of technical. I think there's still a technical June 30th date on the books, but I mean we're no lawyers, but the injunction hasn't overtaken it. But I think like the honest framing here is that open banking in the U.S. Technically has not gone live, but it also hasn't gone away. It's paused, it's contested, it's being rewritten. But like when you think about the missing the forest for the trees, like the direction is still there. The direction of travel still points towards a mandated open banking thing, which I can't help but think is really going to be a huge tailwind for cash flow underwriting.
The other thing, we talked about it last week on the news pod. Nick, I was traveling, so I just riffed on this. I don't know if you caught the episode. I know I briefed you on kind of what I talked about, but the big aha moment I had was, and I reread my piece, kind of looked at it and said, hey, the thing I couldn't get my arms around is like, what's going to convince a consumer to give a platform like Credit Karma or Experian their cash flow, the keys to their cash flow. So username and password of all my account. I couldn't think of a great reason for that, what that would happen. And then when ChatGPT and Plaid made their announcement of, hey, we're working together here and they're giving this to Pro Tier, that was my aha moment of like, oh man, that is the reason I would give my open banking data. Because now I can fire up my phone and in a quick voice memo ask anything. How much did I spend on gas last month? How much did I spend on restaurants? Like, I'm trying to manage a budget and I'm trying to get quick answers on how I'm spending my. That's a killer use case for giving the keys over to your bank accounts. And once OpenAI has that, or Karma has it, or Experian has it, or any consumer finance platform, now they can come knock on your door and say, hey, by the way, you've told us you're looking for a credit card. I just found a cash flow based lender for you that's willing to approve you. It's pre-approved, it's done. You just have to click this button and say yes. So to me, we have the makings of potentially the floodgates opening up for these cash flow based lenders. I'm pretty excited to see how it plays out, but like I think I finally can articulate the use case for the consumer that gets them over the edge of sharing what I thought was information that maybe they would never get comfortable with. So I'm really getting more excited about this by the day.
I think it's a great way to end it. Thanks, Carlos.
All right, we'll talk next week, Nick.
All right, bye.